Anglo African oil and gas has just made its debut on AIM, or the alternative investment market here in London, as it raises cash to move into the Republic of Congo. David Sefton is executive chairman. He joins us now. David, welcome.
Thank you very much.
First of all, this is the Republic of Congo, not the Democratic Republic of Congo. Explain a bit more about that.
Yeah, I mean there are two. It's the Republic of Congo is the former French Congo, Democratic Republic, Belgian Congo. The Republic of Congo it's a very nice place. It's a country about half the size of France with a population of about 4.5–5 million people. Very stable place, very long established oil and gas industry, been there about 40 odd years, one of Africa's biggest producers, and fundamentally a very stable place and a very stable environment in which to invest.
This goes some way to explain why you've been able to attract more money than you hoped to attract in the first place on your listing here in London. First of all, congratulations on that, because clearly getting it away is the first hurdle. Now you are away. I think it's brought, what, £10 million onto the balance sheet?
Yeah, that's right. Which is slightly more than we've gone out to ask the market for. But I think there are sort of two things essentially which have really gone down very well with the investor base, and it's a very good institutional investor list that we've ended up with. Firstly is that we have an asset which is slightly unusual for small exploration and production, or E&P companies. Generally speaking, people buy small E&P companies because if the exploration comes off, you get a fantastic multiple of what you've invested in, but it comes with a concomitant risk of total loss if the exploration doesn't come off. Whereas usually what we've got here is an already producing asset with further layers into which we can drill, where we have proven oil reserves. And on that development side, we can get the asset to be worth, we think, more than we're going in on. And yet at the same time, we have a deeper exploration layer to go into, where our neighbouring operators are producing in the thousands of barrels of oil per well. And if that comes off, you get the multiple that everybody wants with exploration. So the usual side is being able to get the sort of potential upside on exploration E&P that everybody likes for a small company, while at the same time, you know that behind all this is a stable existing oil producer, and where we can do a workover and we can do a drilling program into existing layers, so that if the exploration proves more difficult or takes longer, etc., we can afford to do that. We have cash flows, we'll be cash flow stable very quickly, and we can protect the asset in almost all circumstances.
So you and the rest of the management team bought into this raising?
What we did is we put this together, and some of us come from an operations background, some of us come from a PE background. And we structured something whereby we wanted to kind of look at small E&P companies from a sort of slightly different way. They've had difficult relationships with the market sometimes, in that they've perhaps been seen as lifestyle companies or as companies where people invest and nothing much happens for a few years. Whereas here we wanted to hold ourselves to the fire of what we've said, which is we have gone to market and said, look, we will transform the production profile of this asset. So everything about the compensation structure ties to that. Our salaries, our equity, everything ties to us transforming the production. We have to get the production up and get various milestones from 250 right up to 5,000 barrels a day. So it very much sort of focuses us alongside the investors. We can't sit there and not get on and do this quickly. If we do, people aren't going to get paid a living salary. And that's things like that, I think, really do kind of focus the mind. And it marries with what we've said, which is it's a very quick program. We'll very quickly do a workover of two of the existing wells to get this up to 200, 250 barrels a day and get to cash flow stability. After that, and that will only take a month or two. And then in the period from then until September, we'll drill the first of what will hopefully be a series of new wells. This well will go through the existing proven layers, and we'll be able to add production from that. And we'll also do an appraisal of the exploration layer. But we'll get on and we'll do it quickly, and we'll be able to show clear results to the market at a very kind of early stage. And how we benefit financially is explicitly tied to what the production results are. Okay, so
this 10 million you've raised, exactly what is that going to allow you to do before you run out of money?
Well, one of the key things is we won't run out of money. Because one of the first things we do is get to cash flow stability, and we get to cash flow stability by spending $200,000 or $300,000 on doing a workover of the two existing wells, and we have a very lean and flexible cost base, which means that 200, 250 barrels a day we're cash flow break even. So we don't run out of money, right? And we make profits at production levels, incrementally upwards from there. So against a PE approach, first of all, protect the capital. Don't waste capital on day-to-day running expenses. So we get there, and then we go into the new well. So workover gets us to 200, 250. We then start the first of the new wells. That will go through, first of all, the existing production there. Should be able to add 100, 150 barrels a day for that. Secondly, into a layer called the Mango Sands. We have well-logged data showing producible oil in that layer. Neighbouring fields are getting between 500 and 800 barrels a day of production out of that layer. So once we've gone through those two and done the work, we haven't encountered any exploration risk, and yet we have a route with low technical risk of getting to, say, 700 plus barrels of oil a day. At that, we are very, very profitable. And then we do the exploration side.
Right.
So the upside on the exploration, which is the potential thousands of barrels a day, that comes after we've already got a very profitable oil company with a production level different from what it is today.
Okay. And to make clear, this is conventional oil exploration and production?
It's conventional oil, and it's an existing facility, so offtake already in place, topside facilities already in place. It's near offshore, drilled from onshore, so you turn any oil you produce gets turned into cash very, very quickly.
Okay, so the listing today, what does it represent in terms of the outlook? Because you've spoken a lot about your income coming in. What is being priced in at this level?
Well, at this level, not an awful lot. I mean, on the sort of DCF models that we've run internally, they said it's pricing in probably the workover, probably nothing much else apart from that. So,
okay, so you get the money coming in for free at that point.
I think it's difficult always to work out what companies should be worth. Yeah. But there's no doubt it's hard to see anything in the price at the moment which represents any upside on the exploration.
Okay, let's look at some interesting things about the environment you're operating in at the moment. We've spoken about the fact it's the Republic of Congo. Your neighbours, you talk a little bit about neighbours. What is it that they're doing? What was the surprise for what they've got? What are they?
Well, what happened is when we sort of started looking at the asset, we have the existing producing layer and the mango layer, so the layers where we know what's there, and you can build a very good, profitable oil company just off the back of those two layers. And then one of our neighbours, he and I went down deeper than the mango, into this exploration layer, the Geno, expecting to find gas. In actual fact, got about 5,000 barrels a day of oil production. And E&I, Socco and New Age, who have the licence areas surrounding Tilapia, the field that we bought, they have encountered similar levels of production on drilling. And we sit on top of the same structure. So we have very, very well qualified exploration. And when I say that they are our near neighbours, I mean the nearest of these producing assets is about 4 miles away. It's very, very, very close. Now, at the end of the day, that it represents exploration because we haven't drilled into that layer on our licence field yet. So you cannot guarantee what the outcome is. But you look at what they're getting, and you look at the geological structure, and you do the analysis, and so it leads you to a conclusion that that is a very well qualified exploration move to make.
Already producing, 30 odd barrels a day, which is obviously very small, but the infrastructure would appear to be there to get you up to a higher level. What can the infrastructure stand in terms of extra capacity?
It can go to 5,000 barrels a day at the moment. And at that level, we will be throwing off millions of dollars a month of profit. So expanding the facility at that point would not be difficult. And you have, again, you have the advantage here. It's not just that we can cope with that level of production. It's the fact that we've got the facilities already there. You're not having to spend time building them, the permits, the licenses, the permission. It is an existing oil producing company. Yeah. And the difference is between that and, even if you, in a pure exploration play, when you find oil, you've still got to build the topside facilities, drill the producing wells, figure out who you're going to sell the oil to, figure out how you're going to get the oil to them. All of that is short-circuited here.
You talk about millions of profit per month, whatever, at current prices. What are the economics of the project?
The economics of the project, if we got to the several thousands a day of production which would generate that, and that's an if because we're not there yet, if we did, production costs are in fact, overall economic costs, including full G&A, is sub $5 at that point. So pretty low.
And it's good quality oil?
39 to 41 API, light sweet, better quality than Brent, attracts a Brent price.
Yeah, okay. Let's look at some of the headlines we should look forward to now. As an investor buying into this, what should we expect from you as the management in terms of headlines to come?
Well, the first things will be the results of the workover. And I think that is critical because that does get the asset and the company to cash flow stability, and that's a very important point. And then going through the summer, we will have the results of drilling the first well, and we'll be able to see what production we can get out of R1, R2, the existing layer, and the Mengo layer, and we'll see what the results, the exploration results are going into the Geno. I don't know whether we'll bring the Geno onto production from the first well, but at the very least, we'll get some sense of what may or may not be down there. So, and that's a fairly kind of compressed period. It's doing a workover of at least 2 of the wells, maybe doing a workover of the third, plus drilling an entire new well within the first few months after listing. It's the kind of thing that's only possible if you've got an existing facility there.
Yeah. Well, look forward to hearing more headlines. It's good to talk to you.
No, thank you very much,
David.
Andy.
Thanks indeed for joining us. David Sefton is Executive Chairman of Anglo African Oil and Gas, just listed on the alternative investment market here in London.